What's up, Financial Zen Masters? Today I'm going to show you how to avoid taxes on capital gains, especially if it's capital gains on your company stock. But first, welcome to the Financial Zen channel, where the big question is, how can you, a high achiever with responsibilities at home, how can you quit your 9-to-5 grind to go pursue your passion while still providing for your family? That's the question. I got your answers. I'm Rick Valenzi, a certified financial planner, the founder of Financial Zen, and your guide. Okay, so slight disclaimer up front. You never want your investment plan to dictate your financial plan, meaning your financial goals come first, and then you decide what to do with your money. Decide when you need your money, when you need those investments, and then you determine how to invest them, okay? So this is particularly useful for somebody that is sitting a lot of their company stock. We work with a lot of big tech employees who end up having 50, 60, 70% of their entire net worth tied up in their company stock, whether it's Amazon or Google or Facebook or Salesforce or any of these. You often will have a very high concentration of company stock in one stock. So without exception, it doesn't matter what the company, our advice will always be to diversify out of that stock. And so this is a situation where you know you need to diversify out of a bunch of stock. You prefer not to do it all at once, so you want to span it out over a number of months, maybe 6, 12, 18 months. And so this is a situation where you know you're going to be diversifying over the course of at least 2 different years, okay? Now, Uncle Sam is dumb, which means you can use it to your advantage. And what I mean by Uncle Sam is dumb is he doesn't care if you sell on December 31st, then all the taxes you were going to owe him go into this tax year. If you sell on January 1st, a day later, all your taxes will go into next year, right? So there's a quick line, there's a sharp line in the sand where you can determine where it's better to sell more of your company stock. So if you are selling over a number of years, what you can do is run projections for what your taxes are going to look like this year, and then run projections for what your taxes are going to look like next year. And then based on that determine which shares to sell. So here's some real simple math. So let's say you believe you're going to make about 100K this year. Let's say next year you're up for promotion, you have some RSU grants vesting, and you know you're going to make an extra 50 grand next year, let's say. So you're making 100 grand this year, 150 grand next year. Well, that means that you're going to want to sell more of the highly taxable company stock in this year, right? The stuff with the lowest cost basis, the stuff that you bought for the least, presumably the stock that you acquired further back in time, right? So you know there's going to attach big gains, so you want to put them into a tax year where your taxes are already going to be low. So that's how you can be smart about selling out your concentrated positions. If you are not so we do that automatically every tax year, at the end of each year for all of our Financial Zen members. If you are not a Financial Zen member, then you can do it yourself using, if you bought TurboTax last year, it'll let you run projections. It's not going to be perfect, but it'll let you run sort of projections. You can pretend like you're redoing your taxes and do what you think will look like this year and next year and kind of cheat the system a little bit. And that's sort of the best you're going to get if you don't have a CPA and you're doing things, or a Financial Zen member and you're doing things yourself. All right, so I know that was quick. If you didn't catch it all, go back and watch it in slow motion. Seriously, it'll help. Thanks for watching. Subscribe. Let me know if this will pertain to you, and like the video if you learned something. Thanks so much for watching. We'll see you tomorrow.